Hello, everybody. My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, please consider liking this video and subscribing to the channel. Today, we're going to be talking about a very, very interesting small cap, Global Ship Lease Inc. GSL is the ticker. As usual, I'm going to go over the background of the company, what they do, take a look at the financials, take a look at the valuation, discuss the dividend, discuss some of the risks, and conclude with a brief technical analysis, and then a grade, buy, sell, or hold. As always, this is not financial advice. I am not a registered financial advisor, just a guy with opinions. All right, without further ado, let's get into it. Super, super interesting company. This one's been on my radar for a few years now. I did successfully trade it for a modest profit in 2023. You see it kind of bounces up and down in this range between $30 and high teens, $20. At least it has over the last 5 years. About $1 billion market cap. The company, what it does is exactly what it sounds like. It leases ships. Think about it like a landlord, but instead of owning real estate, it owns engaged in marine logistics, right? So container shipping companies, they don't always have the capital, of course, to purchase all of their own ships. A lot of them do. Most shipping companies own some ships, and they lease some ships. They turn to a company like GSL in order to do so. So very, very simple business model. Asset-based, so it's capital intensive. It's pretty much based on the amount of ships that they have in their fleet. It's based on the quality of the ships, the rates that they get for the ships, and they're able to get leases or charters for several years at a time. Very, very, very simple business. Now, if you looked at shipping stocks before, you know that it's an incredibly volatile industry. Shipping stocks are they can be quite the gamble. If you buy them at the right time, they can produce phenomenal returns, and they also have incredible downside when things aren't going well or the cycle is turning down. Because GSL leases ships, it is a little bit less cyclical. However, it's still exposed to a lot of the same market dynamics that other shipping stocks are. So it's cyclical, but not as cyclical. You see that in there. Very small company, 7 employees here, based in Greece. But as for the company description, Global Ship Lease Inc., together with its subsidiaries, engages in owning and chartering of container ships under fixed-rate charters to container shipping companies worldwide. As of March 2025, it owns 70 mid-size and smaller container ships, ranging from 2,200 to 11,000 20-foot equivalent units, or TEUs, with an aggregate capacity of 404,681. Okay? Very, very simple business. Take a look at their website. I believe somewhere in here they have some sort of, if I start itching my arms, it's because I'm dealing with a super gnarly case of poison ivy and contacting it, getting it from working on the ranch. Anyways, interesting presentation here. Tariffs, trade disruptions, geopolitical tensions, uncertainty. 397 million contracted revenues added in the first half of the year, August 5th. Okay, so we're getting close to the upcoming quarter here. 96% forward contract cover for 2025, 80% for 2026. In other words, that's the level of visibility or revenue visibility that they have. That's a great thing about this company, that they have a little bit of revenue visibility. It's not very long into the future, only a year or two, because ships aren't really leased for long periods. Selective ship sales build dry powder for fleet renewal. So as the ships age, they sell them off. It takes a lot of money to buy and lease ships. It's an asset-based business. As I've discussed before, I like asset-based businesses. Given my background in real estate is, of course, an asset-based business. GSL fits that mold. The reason that I like asset-based businesses is because of how simple they are to understand. You go out, you buy an asset. Um, Usually, it's easier to finance the purchase of assets than it is other things. So you can use debt, purchase assets, and turn around and derive the revenue off. Now, one thing to keep in mind is that assets used in asset-based businesses appreciate, including real estate. Real estate depreciates, right? The actual improvements. So, of course, ships appreciate and they need to be replaced. We're not going to do any sort of sophisticated analysis of that, and I think you'll see why that isn't really required, purely because of the valuation. So in the quarter, we had 192,383,000 for the first half of the year. So that's like 750 million annualized. So that puts our price sales just over one. It's like 1.25, right? 1.5. Net income of 93. Adjusted EBITDA 134 million. Normalized net income 91 million. Let's just round up to 100 million for simple math. And then let's say that the market cap is $1 billion, rounding up. That means that our price earnings is like 2.5 on this. So it's exceptionally cheap, right? See our earnings per share, 601 over the first half. So that's $12, right? $12 annualized versus a $28 price. Exceptionally cheap valuation. So here we're looking at their charterer base, shipping companies that pick up each of the share of contracted revenues. Hapag-Lloyd, I believe Hapag-Lloyd or Maersk, either one of those companies is the top shipping company in the world. Check me if I'm wrong on that, audience. But largely, I think that at least these top two companies are, either the one or the two, or 1, 2 biggest in the world. So I guess it makes sense that they're the top. So we don't necessarily have a ton of exposure here to fly-by-night, small, no-name carriers here. These are legit players. Zim, of course, is the Israeli company in the sea. I'm not much of a shipping nerd, but I do recognize a lot of these names here. Okay, so 1.7 billion of contracted revenues as of June 30th. Over 2.1 years of average remaining contract cover. 22 charters added in the first half, including extension options exercised, and 397 million additional contracted revenues added in the first half. Again, measure that versus the valuation, and that's exceptionally deep value. So I think we're going to get into later why it's so cheap. I think I have a few theories as to why, but we'll get to that in a moment. Dynamic capital allocation through the cycle. They acknowledge the cyclicality of shipping. Capital allocation driven by relative returns adjusted for risk. So they're paying out a dividend. Their dividend is quite high. Again, $2.10 a share. That's roughly 7.5% of today's price. Very juicy dividend. And they're buying back shares. Delevering to manage balance sheet risk and build equity value. CapEx to meet evolving regulatory and market demands of decarbonization, energy saving, retrofit negotiations with charters, ongoing cash liquidity for resilience, accretive growth, and fleet renewal. That all just sounds very boilerplate. Cycle to generate long-term value for shareholders. So the business model is intended to provide investors with a stable and liquid platform to participate in cyclical upside and positive volatility of the industry while mitigating exposure to downside risk. Share liquidity to allow investors to enter and exit opportunistically. Easier for investors to buy and sell GSL shares than buy and sell ships. Ain't that right? I would love to buy and sell ships. I mean, I don't even know what each ship costs, but I imagine that it's several $1 million each, right? They said they had 70 ships across a $1 billion market cap. So that gives you an idea, right? That implies that each ship is worth, well, what's the price book value? I think the book value is twice the market cap. That basically implies that each ship is worth, 20 something million, if I'm doing that math. So this makes a ton of sense, right? So in other words, we have very big swings in our industry here, but because of the economics of the GSL platform, given that they're kind of a second order beneficiary of the shipping cycle. When there's more demand for shipping, there's more demand for ships. When there's less demand for shipping, there's less demand for ships. However, because they contract out several years into the future, like here, they've got 2.1 years of average remaining contract cover, because they have some duration in their cash flow, 2 years at a time, whereas the shipping cycle might be quarters at a time, right? So, the shipping may be way up in this quarter, in the first quarter, and then by the third quarter, way down. But all throughout that, GSL is much more smooth in their cash generation. So this isn't just management fluff. It makes a lot of sense to me, and I think that the company provides strong appeal in that way. There are several reasons, but one of the reasons I think it's so cheap is because all shipping stocks are incredibly cheap. All shipping stocks are incredibly cheap and trade, at super low multiples because of how volatile shipping is. And I think that GSL just kind of get lumps into that category as well. So to that end, whether or not it deserves to have that low of a multiple, given that it arguably might have superior economics to one of the container or the shipping company, that is something for investors to weigh in on, I guess, with their dollars. So I kept getting distracted as I was talking because I'm looking at this graph here and I'm trying to make sense of it. So these indices here, charter rate and asset value indices, I think, so this green line here is our charter rate index, so the how much it costs to charter ships. Obviously, there was a huge boom during the kind of post-COVID era inflationary spike because there was a huge supply chain disruption. You turned off all of shipping right here, and then so much money flooded into the world economy. Everybody wanted to buy stuff, particularly in the United States, and that created a bunch of demand for products. So shipping really boomed in that, but it was obviously very transitory. Now, what we do see here is that that was very short-lived. However, rates are still higher than they were prior. You see here from 2011, pretty much to the start of COVID, shipping was in a dearth. Where we're at now, rates are more similar to what they were in the early 2000s. So you see how shipping has just kind of been a pretty crappy industry to be invested in just because of the rates. And then here they're talking about their acquisitive activities. Interesting to note, November 2018, GSL and Poseidon merged, doubling the fleet. And then you see here they've continued to acquire. I don't understand how they're using the cycle, but I guess what they're trying to highlight is that at some of the lower points they're buying, and they're not buying when prices are super high. Because you remember this is the new build, this is the second peak. Notice how new builds are more stable. So very fascinating chart. This helps explain some of the price action that we'll look at later. They talk about some of their balance sheet, P&L. We'll take a look at that through Seeking Alpha as well. We looked at some of the P&L numbers, but in terms of the balance sheet, Gross debt, 768.5 million versus half a billion of cash. Well, that's pretty good, right? That's pretty good. They got plenty of cash on hand relative to their gross debt, not their net debt, their gross debt. 85 million refinance, pushes weighted average debt maturity to 5 years, 4.2%, and $28 million gain from sale of older ships. Supplemental dividend introduced in second quarter of 2024, increasing the quarterly dividend by 20% to 45 cents per common share. So we'll see pay out this supplemental dividend. Ongoing deleveraging, equity value. They're saying ongoing deleveraging, yet debt is up. Interesting. 33 million remaining under optimistic share buyback. Financial leverage now below 1 time. De-risking the balance sheet continues, so they're looking at that a little bit more they're zooming out on it. Very detailed slides here. Minimizing vessels' average daily break-even rate. So we've got our daily interest expense paid. I'm pretty sure that charter rates are per day. That's why they have this as a daily break-even rate. We got OPEX has come up a lot. Interest expense paid has come down a lot. Again, that kind of coincides here. Because they have way less leverage, they're paying less interest per voyage unit. Mid-sized and smaller container ships, flexible assets, and backbone of global trade. I'm not going to focus too much on this because I'm a little bit out of my element. I'm not like I said, I'm not a shipping nerd. So I'm not going to pretend like I understand a whole lot of this. What I am going to do is attempt to make sense of it in ways that make sense to me. Sub 10,000 TEU, just sub that size. 74% of global containerized trade volume in non-man lane trade. So I think that just means that what they focus on, the mid-size and smaller container ships, is 3/4 of trade volume, containerized trade volume. So that kind of gives you an idea of the scope of the addressable market, which I think is fascinating. Again, I don't know what the market share of this company is relative to that addressable market. And again, this isn't the true addressable market because a lot of those ships are owned by the shippers. Just something to keep in mind. The Red Sea disruption, again, that's the Houthi rebels in Yemen, I believe, firing at ships coming through the Suez Canal. That's put upward pressure on rates. If we go back to this rate chart here, I believe that kind of happened around here. That's kind of kept rates higher than they were before. So while Red Sea shipping disruption is not a good thing for the world, it's not a good thing for inflation and for consumer prices, it has been a benefit for shipping companies. And you see here 20% of global containerized trade volumes, cargo passing via the canal, 34% of global container ship fleet capacity employed via the Suez Canal pre the Red Sea disruption. So rerouting through this, I don't know what this, Cape of Good Hope. So instead of going from here to here or vice versa, we now have to go all the way around Africa. So because ships have to go around, they take longer. Therefore, there are less ships in supply to take the next incremental load. It appears that this is from Maritime Strategies International. So they're saying, yep, that takes rates in charter markets higher. Absorption of effective capacity is supported. So something to keep in mind. I mean, we'll discuss later in the risk factors, but something to keep in mind that this phenomenon has been propping up rates. So you had COVID, which really shot up rates. They came back down to earth, and then we had kind of this conflict that's kept rates higher than they were pre-COVID. Impact on demand from U.S. tariffs is unpredictable. 2019 trade tensions may be constructive directionally. I'll tell you what. I mean, the detail in this deck is incredible. I'm super impressed with this deck. It's just super detailed. So I think what they're talking about here, they're saying this is what happened in 2019. Okay, so from China to U.S., reduced direct trade, that lane, disruption to China-focused supply chains, negative impact on very large container ships dependent on direct Intra-Asia, increased trade volumes, diversification of supply chains throughout region, increased demand for small and mid-sized ships to support indirect hub spoke trade. So regional trade volumes increased with tariffs. Supply chain diversification has persisted. Increased inefficiency of the supply chain can drive increased demand for shipping capacity. So the way that I read that is they're basically saying, hey, this thing right here is an inefficiency in this supply chain. That put rates up. And basically what they're saying here is more inefficiency in the supply chain can drive increased demand for the amount of ships, basically because it's a supply shock. What I'm becoming aware of, or at least what I'm keying in on, is this level of detail in the deck is a consequence and result of the fact that this industry is so cyclical and there's so many things to discuss driving the dynamics of the shipping industry that they realize that it's important to discuss all of these factors. Nonetheless, I'm very impressed by their presentation. Supply side trends. So speaking of the supply side, idle capacity minimal, scrapping still largely on hold. These are things that I don't really understand. I don't understand what idle capacity means. I guess I would assume that it means a ship that exists that isn't being used. So when idle capacity is high, downward pressure on rates, right? Because there's so many ships to absorb new loads, and I guess that makes sense because we see what happened. What happened right here? This is COVID. This is March 2020. So then you see, we remember if we looked at that graph of rates all throughout this period, rates were very low, right? In shipping, and we see here that the green line, that's the idle percentage of total fleet. So we've kind of peaked twice in the low teens, and we've hovered in the high single digits. However, in the post-COVID era, we still continue to be exceptionally low. So something to understand if you like this stock is that the market, the shipping market, is still very strong. Prices for ships, I think that this is part of the reason why it's trading so cheap, is that the market is pricing in this eventual reversion to the mean. And I think that that's a very reasonable direction for the market to take. However, one thing that continues to persist with this stock is it seems like there continues to be disruptions to the supply chain that ultimately are keeping a floor on rates. You had all that, the Red Sea debacle, the Red Sea disruption, they call it, kind of kicking that off. And now the tariff thing is creating uncertainty. Normally, uncertainty would lower rates due to less capacity. However, remember, this is a global company. They're basically saying that they're positioning or will be positioned to take advantage of more freight exchange on the smaller ships between these countries, not necessarily all the way across the Pacific. So we're exposed to global shipping, not U.S. from China or China to U.S. shipping, which I think is interesting from a diversification perspective. Ship recycling modest. That's, I guess, scrapping. How many ships exist that we're putting to, taking out of the supply. And you see here, this scrapping rate coming up is what helps prices come down or go up when they're very low. They're saying, yeah, that didn't happen at all. And this is the global container ship fleet. So there wasn't a single TEU scrapped in the first half. So that gives you an idea. Again, we're in a very strong market here. Very strong market. We're not in the depths of a freight recession. Arguably, that would be the best time to buy shipping stocks, is when we're in the depth of a freight recession. And we are very much not. Overall order book is meaningful, but our sector-focused fundamentals remain supportive. This is getting pretty complicated. 29.6 order book to fleet ratio. The number of ships that are being built versus the number that exists. In other words, that would put downward pressure on rates. They're saying, hey, these are our sizes of ships. That ratio is not great. Oh, yeah, okay, so they're saying our order book to fleet ratio is much lower than the overall, because look, there's a ton of order book for these huge container ships. They're saying that the implied net growth of the sub 10,000 TEU fleet through 2028 is a 6.3% contraction. So they're estimating that the supply crunch will buoy their economics. Charter market rates, first half still supportive, but forward visibility is limited. Again, we see rates are pretty good. Average break-even rates are well below market rates, meaning that cash is being printed. I think the way we look at this, the revenue and profit and everything is fairly safe over the term of their contractual obligation. And, if you've got 2 years of revenue visibility and you're trading at a 2 3/4 price earnings, the market doesn't seem to give this company any credit for what's happening much beyond their stated contractual values. Super interesting situation, I think. I'm going to use this and just take a look. Again, COVID has really buoyed the revenues of the company from this more steady state. You see, prior to that, revenues were hanging around, 160 million a year. 2019, they started edging up. 2020, kind of was a topsy-turvy year. But by the time after that, shipping booms, it really started to come on. Now, one thing that I want to highlight here in their financials that I think is important for us to understand from the investment perspective. Prices were low, then they were high, then they were lower, and they're still doing good. Now, one thing to note is that you very much see in their revenues that, again, this is annualized. There was no period of 2022, 2023 in terms of their revenue that decreased because, like I was saying, they have the smoothness of their contracts, of their charters, that smooths their revenue. So they've continued their upward momentum. And you see here, gross profits, 115 million on 165 million of revenue in 2015. Over the last 12 months, 509 versus 730 million. I'm just going to do the calculation on my phone. Actually, we've got this. Our gross profit was like 70% in 2015, and our gross profit in the last 12 almost identical. So that's interesting. Maybe we'll look at a chart of their gross profit over time. But typically with stuff that's really cyclical, you see a expansion of gross profit during boom times. We're not necessarily seeing that here. We'll look at the graphs we see each year. However, I find that to actually be a good thing from the standpoint of it does imply, again, we need to do more analysis, it does imply that their gross profit margins are somewhat stable throughout different points of the cycle, which I see as a positive. And then we see here their operating income. Okay, so it's not a great metric, but 64 versus 115 versus 390 over 509. I'm not going to do the math on that, but it does visually appear that there's a little bit better margins on operating income than on gross profits. But because there's so much depreciation, I'm just not going to worry about that. You do see here SG&A does appear to flex pretty hard with revenues. Interest expense, of course, is important. We know based on looking at their slide deck that they have delevered in recent years from what they used to be, which has really helped out their earnings. So it seems to me that the management is very, very keen, as they should be, to the fact that the industry is cyclical, and when times are good, as they continue to be, and they are making a lot of money, it is good that they pay out a strong dividend and good that they pay down debt. So when times are more lean, they can hopefully continue to do well financially. And you see here that they didn't make money. Although they were making solid gross profits, they were not making a profit in these more lean years. So I think that also contributes to the very low valuation. It is objectively very cheap. However, the market the market is aware that it's very cyclical, and the earnings and profits aren't necessarily durable across different cycles of prices. Uh, we do know that in 2018 they merged with that one company that they mentioned in the deck. It is possible that they have better economics now than they did prior. I think if there were to be a down cycle in shipping, obviously the stock would not do very well. However, it is possible that they could do better than they did during the last long scale freight recession. So just something to think about. We see here, I think this is another reason why their valuation is cheap, is because they issued a lot of, over the years here, to make what I assume to be vessel acquisitions. Um, we know that 2018 is when the merger happened, so these shares don't really coincide with that. It's almost like they replaced debt with equity. I don't know, where is their debt? I guess we're not looking at their balance sheet. So shares have gone up over time. However, they have paid down some of it peaked in 2022, where they paid that down. So their revenue per share was actually higher in 2015, 2016, et cetera, as it's been over the last few years due to that dilution, even though the underlying economics are clearly superior. So interesting looking income statement, but there's definitely a few things there that indicate, maybe the lack of durable quality that we see in this business. Cash and cash equivalents, they're obviously much more flush with cash. They've done a good job of holding on to cash that they've made over the last few solid years. And in fact, this graph doesn't really show it. They don't show the last report number in the graph, but it is substantially higher. We see the last report is 415 million. So that's, several times higher than this bar here, being that this bar is 141 million. So they have lots of cash, especially compared to the amount of receivables. Their current assets is a majority cash, so very flush with cash. We see here, interestingly, $2.3 billion of property, plant, and equipment. Of course, that's the line item that would hold their ship inventories minus the depreciation. But effectively, the gross value of those ships, 2.35 billion. And, they might own real estate or other things too, equipment, that kind of thing. But they've got quite a few. They have at least $1 billion, if not more, of ships. I think is safe enough to assume by just looking at that line item there. That's steadily trended upwards. I think what's key with this type of business is if they steadily increase the amount of capacity throughout the cycles and they finance those purchases very intelligently, that's kind of what measures success for the company relative to the industry. But we're still also exposed to the cyclicality of shipping. So ultimately, 2.6 in assets, the majority of that appears to be their ships, which makes sense. Current liabilities, 128 million of the current portion of the long-term debt. So they have more than enough cash to meet their current liabilities. This is frankly one of the better balance sheets that I've looked at lately. I will say that. Their long-term debt, again, continues to slide. So while their share count has increased since 2018, their debt has not. It has decreased. So kind of a mixed bag of results there. But while they don't have enough cash to pay off all their liabilities, they certainly have enough cash to pay off their current liabilities, which is what you want to see. Definitely what you want to see. So despite the fact that they have more cash, again, this is more, just another product of the share count. Despite the fact that they have way more cash than they used to have, their cash per share is much lower. And their tangible book value per share is also much lower than it was in 2015. However, something else to note here, that the tangible book value per share, $46, substantially more than their equity value. So this is just kind of that metric alone, I think, gives you a good idea of the margin of safety here. That what you're, if this company is going bankrupt at this price. Again, this is book value, so they're not necessarily marking to market the value of their ships. I would assume that they're holding them at cost. In which case, at today's price, even if there's a dearth in the shipping market, you have quite a bit of margin of safety, I think, in just what the equity value is at the current price. So, Seeking Alpha has the valuation at an A plus. I very much agree that it is a screaming deal in terms of the book value. I think the book value, again, it's an asset-based business, so price book is a very, very appropriate metric to value the business, and price earnings is not an appropriate way to value the business, especially given the cyclicality. But really, it doesn't really matter how you dice it. It is objectively very cheap, so it very much does look very attractive. And their dividend also very attractive. You see here, their dividend has really traded between 6 and 8% for the better part of the last few years. So, in terms of the dividend yield, I think the shares also appear to be very fairly valued. But you see here, when we break it down in terms of a multiple of free cash flow, we got just eye-popping yields in terms of the valuation there. So, yeah, very good-looking numbers. Now, one thing that's been surprisingly good about this company has been dividend growth. Now, here in these really bad, again, they've paid out much higher dividends than they have here before. You see, they don't have a consistent dividend history. So, arguably, the market is really looking at this period. I certainly do. I certainly look at this period, and I don't get super excited about the dividend because of the history of the company. It is possible that if we enter another freight recession, although the value of your equity, I think, at the current price is well insulated, the dividend might not be. However, they've had really strong dividend growth from 25 cents per quarter to over 50 cents. So we've doubled the dividend in just a few years. Really, really instructive. I think we just need to look at the payout ratio. And the payout ratio, pretty good. It's effectively less than 50%. Here we're saying that over the last 12 months, it's about 50%. On a GAAP basis, it's much lower than that. And on a forward basis, non-GAAP, much lower than that. So one thing I'm not going to do is go into their free cash flow. I'm just going to take the free cash flow at face value implied by this metric here. We know that it's objectively very cheap, and we know based on looking at their financials that there's free cash flow. Very, very clear. So I would say that the payout is very much safe. There's nothing about that level of $2.10 in dividends. Their earnings per share over $10 annualized forward. So those two numbers are so far apart from each other, I don't really feel compelled to investigate the safety of the dividend. It appears very safe. However, the rates continue to be elevated. So if you're looking at this purely because you want the dividend income, that might be something to investigate. What's the durability of that dividend if earnings were to decline? Again, if earnings were to decline by half, right? By half, that would still imply that we have a payout ratio less than. That doesn't really acknowledge free cash flow. That's just earnings. However, that gives you an idea maybe about the safety. So while the company is certainly priced like the earnings are not durable, it does appear that the dividend might be durable here. The only thing to note is the company has a history of dilution, and the company has a history of not paying consistent dividends. So I think that's another reason why it's perhaps at the valuation that it's at. It's not being given credit for being a consistent payer as of yet, but that can certainly change in the near future. We're getting low on time, so let's advance here to the a brief technical analysis. Zoom out here. So this is over the last few years. I don't know where to put myself over here. Okay, so we've really been in this range. I guess yeah, here we go. So a couple things stand out. We've got this trend line. This has existed during the current shipping bull. And then we've also got this level here. So very clear channel up here where we've been bouncing along. What's interesting is that the company actually broke out above this level recently. And then the comment that Donald Trump made about tariffs appeared. I don't know I guess these are day-long candles. So there was some front running of that news here. But, recently shares got all the way up into the low 30s, $33 a share. So we've dropped almost 20% in the last month here. So we were broken out above this long-term channel. Stock was gaining quite a bit of momentum. The stock went from less than $20, but almost doubled. It went up like 80%. You see there is volatility here in this name. But we've broken back down into this channel here, that this long-term uptrend. So I think one could assume that there is continued or further downside perhaps. A couple things stick out. Looks like we had there were two different times that we really got pretty close. That was kind of more of a downtrend there. And then also we had this level here that we bounced a few times. So I guess either way, I would identify this zone right here as being, if we are going to bounce down more, it could retrace all the way to 25. However, this level where we're at here, the current level that we're at now is effectively where the price was in July 2024 before it effectively peaked locally, downtrended here. It ripped beyond that July 2025. Where we're at now potentially is a level of support given the prior resistance. We're about to find out. The next level would be right below 25, and then the next level we're probably just approaching this trend line. So I see a lot of reason to be cautious. Technically speaking, with the way the chart looks here, and I understand why the market has had a lot of fear. However, I think that this steepness, one thing I don't have is a momentum indicator, that like oversold, overbought indicator. I would imagine that it's flashing oversold, given just the dearth of this drawdown, this 20% drawdown. So while there's a lot to not like about this chart, I think there's a lot to like about it too. So ultimately, I understand why the stock is cheap. I don't think that it's ever going to be expensive. I like the dividend. However, I'm not convinced about the long-term durability of it, but I'm certainly a lot more convinced about the long-term durability about the dividend and the earnings quality. So there's a lot of reasons to not like shipping stocks. And we continue to be in a strong shipping market, and there's risks from tariffs. There's lots of risks. However, I think it's so objectively cheap and has very strong economics relative to the sector that just I think it's worth a small flyer in a portfolio that's focused on income generation. There's enough value in the valuation, and the management has shown some promise and dedication over the last several years to a more disciplined and consistent capital allocation strategy. And so I think if that persists over time, you could see some multiple expansion. However, the multiple on this company is it's probably never going to be double digits. It's never going to trade at 10 times. But objectively, compared to a lot of other places in the market, I think it does present a strong value, Seeking off a quant here has it in a strong buy. I don't know if I'd go that far to say that it's a strong buy, but I certainly think that it's a decent risk reward, particularly when looking at the book valuation. However, I wouldn't expect it to roar to the upside with strong volatility. I would expect it to be a little bit more steady. And there's certainly downside at the current price because we're at the higher end of the range that has been over the last few years. So, yeah, the current price in dollar terms versus where it's been is a risk. There's downside risk there. The chart presents a couple of landmines, I think, something to be aware of, but a few things to be optimistic. And of course, the cyclicality of the shipping industry, tariffs being so uncertain, could eventually just create a freeze on shipping activity. However, per the slides in their deck, it appears that the opposite has been true thus far. So that's going to conclude our video today. Hopefully you found this interesting. I think this is a very interesting company. Comment below, let me know how I'm doing. Give me more suggestions on tickers you want me to look at. I think that this is a very, very interesting one that should be on the radar of people who are focused on value and interested in a very modest dividend. So anyways, this has been great. Thank you so much for watching. If you've enjoyed this video, consider liking the video, consider subscribing to my channel so you see more. And until next time, I'll talk to you later. Have a good rest of your day. I'll talk to you soon. All right, bye.